Hey there, people. Welcome to episode number 19 of the Under the Radar Real Estate Podcast. As always, I'm your host, Josh, and let's jump right into it. So, we are, as always, live reviewing the market stats from October 2024. Today is November. It was election week in the US. We're not going to be talking about that on this podcast. But we're going to talk about where the market's at. Now we're pretty much halfway through the fall market. So we have a really good read on likely how things are going to turn out for the rest of this year. And now we can actually start looking into 2025 and seeing what's likely to happen as we move into 2025. So before we get into the live reaction to the market stats, I have taken a quick peek at some of the headlines. So I kind of know what's coming. And I, I saw also some of my own stats and looking at like where the market was last month. I already kind of know what's likely going to be contained in this, but it'll be really interesting to see breaking down the nitty gritty of what's actually going on. But before we actually get into the live reaction, I'll pull that up in a moment on my iPad here on the screen. I'm going to give you a little bit of where things were at in terms of my own business, and it's likely going to coincide with what the numbers are for the month. So over the last month and a half, I actually personally have noticed a little bit of an uptick in activity. A lot of buyers and people that I've been speaking to over the past year to 18 months have finally kind of become activated over the last little bit. And a lot of that was always obviously precipitated by the lowering rates. So people are a little bit more confident now getting into the market, understanding that rates are coming down. Prices have already come down. So anyone who had been looking for a home, obviously saw this as a great buying opportunity with low rates and probably either at or near the bottom of pricing. I know we've been saying at or near the bottom of pricing for a while. A lot of times just hedging bets. You're not sure of where the market's headed. At least for the next little bit, we already knew that the bottom was in. I mean, prices are unlikely to come down even further at this point. So, yeah. And that was reflected in market activity. So, certain things like if we looked at the condo market, when you read news articles and so on and so forth, there was a lot of inventory. There was a video on my channel talking about 6,000 plus unsold condos, and we're still sitting at some pretty high inventory marks when it comes to condos. But the one thing that's not talked about is like good condos and family size condos, for example, or condos that are beyond a bachelor or one bedroom, actually selling at a decent pace now. So end user style condo units are moving. I had a condo listing in King West. It was up on the market for 3 days and sold. And this is with a ton of inventory. Now, the unit I had, it was on a higher floor. It was a one bedroom plus den, but the den was fully enclosed. It was set up as a bedroom and it had two full washrooms. So this is a type of unit for an end user. It makes a lot of sense. It was over 700 square feet. It was a great option for a single person that wants extra space or a couple. Especially a young couple, if you're thinking of having kids in the future, it gives you that little bit of flexibility where you have the extra space to put in a little nursery if you wanted to. Now, on the flip side, I actually had a house listing as well in the East End, and it was a little bit of a different scenario entirely. There's a pocket of the East End. When you get out past Greenwood in the East End, there was a lot of inventory in the fall. So listing came up, a lot of inventory. I think within a 500-meter-ish radius of the property. At one point, there was 40 house listings on the market. So it took just over 20 days to sell that house. It did sell. And we did have multiple offers on the house, but it did take a little bit of time. So basically what I'm getting at is that while the market stats are going to say one thing, there are changes. There are going to be like little micro markets and pockets where you might be in a buyer's market, some pockets you might be in a seller's market, and so while the overall stats will say one thing, depending on the neighborhood you're looking in, there could be different market conditions. And that's what I experienced in my own kind of experience in the market over the last month or so. So I know what you all are here for. You are here for the market stats, market report. So let's dive into that right now. All right. So market stats from October 2024. So I always like reading the spin of what the Toronto Real Estate Board likes to put out. So Yeah, so we're looking here. The first line says, while we're still in early of Bank Canada's rate cutting cycle, it definitely does appear that an increasing number of buyers move off the sidelines and back into the marketplace, which is true. Just said the same thing. I've noticed a uptick in my own business. Um, Positive affordability picture brought about by lower borrowing costs. So always put affordability in quotations. Relatively flat home prices prompted this improvement in market activity. Yeah, so obviously positive comments coming from the Toronto Real Estate Board. And yeah, I mean, ultimately, October, especially when we looked at the previous year or so, numbers were quite positive for October when it comes to home sales. Um, I think go into here that, yeah, let's just dive right into it. I mean, they're going to talk about a whole bunch of spin, and let's just jump right into it. All right. Sure, the numbers up here. You can see them. Let's just get right into the main part of the report that I like. So I'm going to zoom in on it right here. This is just the general overview of the entire GTA. So sales, as I mentioned in the outset, up 44% year over year. As you always know on this podcast and with me, year over year stats taken with a grain of salt because I mean last year was one of the slowest years we ever had in real estate. So positive change there. But we'll look at the month over month stats later on in the podcast to actually see where we're really at. New listings up 4.3%. So that's a little bit down over the last month, which is good that we're not continually flooding the market with new listings, which allows some of the current listings that are sitting around to hopefully sell. And then the next stat is active listings up 25%. So yeah, there's still a lot of active listings. And I mean, up 25% over last year, not over last month, right? So there's still a lot of active inventory in the market, which then, I mean, sales up 44%. So those have been a lot of sales in October. However, because of all of the inventory that's currently still sitting on the market, we're not seeing a huge pressure on price just yet. So price is just up 1.1% year over year. Later on, we look at month to month. We're probably going to notice that there's not a huge increase in pricing, even with the increased sales. And that's just due to the sheer amount of inventory. We're still in a either balanced or buyer's market in many neighborhoods in the city of Toronto. Days on market also up. Again, days on market is up due to inventory. Buyers have choice, so they're not necessarily not homes aren't necessarily selling in under 7 days like we see in a hot market. I mean, because buyers have choice, they can take their time. They can look at different properties and choose whatever fits best for them. So those are the overall GTA market stats. Let's now dive into the 416. We're a Toronto-based podcast. I'm a Toronto-based realtor. While I looked to the 905 to kind of get a read on what things going on there. I mean, in my bubble of the city of Toronto, um, it's it's not really important to this podcast. Enough rambling. Let's look at the 416 number. So, some big numbers in year over year change, right? So when we look at sales, when we look at year over year, up across the board, even condos, right? 30% more condos sold last month, or October 2024 versus October 2023. Detached houses up huge, 44%. And a lot of that's due to pricing. I mean, anyone who desired getting a detached house, now was the time, right? I mean, pricing was probably at its lowest it's going to be in this cycle at the very least. And with all that inventory, people were able to negotiate and knock prices down a little bit over the list price. So we actually saw even pricing go up by 4% a little bit over last year. Same thing for semi-detached, right? So kind of the gems of Toronto real estate, a detached or semi-detached house, people were jumping back into those housing types because in most cases, pricing was a little bit depressed, right? So when we look at the average price of a detached house, 1.778. At some point during the pandemic, that average was over 2 million. Semi-detached houses, same thing. Pricing averaging around 1.3. There was times over the last few years during the height of the market where that was trending upwards of 1.7 million. I think it might even hit close to 1.8 at some points, right? So significant decrease in price for semi-detached as well. Then townhouses and condos are relatively flat over last year. And I mean, that's also due to the fact that, I mean, when we look at condo and townhouse prices, even when we look at the peak of the market, while pricing has come down, it hasn't had the same massive variance in price that we saw in the higher priced home types, right? Detached and semi-detached. So I think townhouses, again, I'm just quoting these numbers off the top of my head. I don't know for sure, but I think townhouses, I mean, even at the peaks of our crazy market over in 2021 and 2022, I don't think townhouses really surpassed any higher than 1.213. So they have come down. When we look at total dollar value versus semi-detached or detached, those are massive amounts of money when we look at just dollar on dollar, not percentages. Um, so yeah, overall, no real surprises there. And I say no real surprises because, as we all saw in the news, and if you follow rate announcements, rates had been coming down in October, right? So, peak of fall market, the Bank of Canada started cutting rates, which then affected mortgage rates. And we saw the fixed rates on mortgages come down. I just personally renewed a mortgage at just over 4%, right? I mean, we hadn't been seeing rates around 4% in a long time, right? So I got a 3-year renewal at just over 4, right? And if we continue this rate cutting cycle, I wouldn't be surprised if within a couple of months we start seeing rates back down sub 4 again, which are in the threes. Not a predict. I mean, I'm not saying for sure it's going to happen. It's my own prediction, so take that with a grain of salt. But I mean, it's looking like we're headed in that direction. Um, Today's also post-election in the U.S. We already saw a lot of economic activity happen yesterday and now into this morning with, I mean, the stock market has rallied, but the bond market is starting to go the other way, right? So the bond market is usually indicative of where rates are going to be headed. So with the bond market starting to trickle down a little bit, it likely means that we're still going to be in a rate cutting cycle, and we'll likely start seeing some more downwards pressure on interest rates. And the Bank of Canada here has said so much as well that I mean, the economy here is still struggling, so they're likely going to continue their rate cutting cycle. So all in all, we know what that generally means to real estate, which we'll get to in a minute. Let's keep going through the updated market report to, again, get an idea of where we're at. So the other thing, if you've been following our podcast, that we like to look at is some under the radar stats, which is months of inventory and sales to new listings ratio. So that is all of Toronto. I mean, that's all of the GTA. Let's look at Toronto specifically. All right. So anyone who's watching this for the first time, sales to new listings ratio is an indicator of kind of market sentiment over here, buyers, sellers, balanced market, right? So sales to new listings ratio, if we are sitting at 50%, means we're in a balanced market, which means neither buyers or sellers have the upper hand in negotiations. If we're sub 50%, generally means that we are in buyer's market territory. A better explanation of sales to new listings ratio is the amount of new sales that are hitting the market versus the amount of sales of new listings that hit the market, right? Sales to new listings ratio. So the amount of new listings that are getting sold as they hit the market during that given point in time that month. So when we are sub 50%, that means less than 50% of the new listings that are hitting the market are selling, which would indicate in most cases that we are in buyer's market territory. Buyers have the upper hand in negotiations because there's a lot of listings hitting the market and not enough sales to absorb those new listings. When we are over 50%, that's now showing a trend towards a seller's market, right? So as new listings hit the market, they are getting absorbed and sold at a rate above 50%, right? So at busy points in our marketplace, we saw sales to new listings ratio upwards of 70%, so over 70%. And when we look at 2021 and 2022, over 70% of new listings that were hitting the market were getting sold. So we're tight market conditions, which was leading to a high sales to new listings ratio. So when we look at the overall numbers from October pretty much across the board, it was showing October as buyer's market because of the amount of inventory that was there. And that was reflected in some of the numbers we just reviewed, right? So when we looked at pricing, pricing was pretty flat across the board, other than really detached house prices that were up quite a bit. For the most part, most of their house types, we were in balanced. We were like, pricing was fairly balanced. They weren't really up over last year. And that was because it was a lot of inventory. So a lot of sales, but we still had a lot of inventory. So when we look at overall City of Toronto, 38.3% sales to new listings ratio. So that indicator would say we are firmly in buyer's market territory. And then we break down neighborhoods. I think there was only one neighborhood in the entire city that broke 50%, which was E03 out in the East End, was just, or no, sorry, two neighbors, and E02, just over 50%. So they were nowhere near seller's market. They're more just balanced market territory, right? And even though I give you that story of that house I sold in the East End, we went to market in October and sold in October. So we still fell into that. We sold within that given period of time. So it shows that we were balanced, right? So most properties that did hit the market in October, for example, sold within that same month. So that kind of gives you that balanced market. So for the most part, the downtown adjacent East End, right? So E02 and E03, you're kind of taking like a little bit of Leslieville, the beach, Upper Beach, Woodbine, Lumsden. So kind of like that East York down to the lake pocket of the city was the only real pocket of the city where we can say it was balanced. For the rest of the city, we were firmly in buyer's market territory, right? So West End, everything under 50, a few neighborhoods under 40%. Downtown, we look at the condo dominated neighborhoods, unsurprisingly, well below 40. We were looking at, some of them trending, flirting with almost 20%. When we look at CO1, only 31.4% sales and listings ratio, which means, though that neighborhood is dominated by condos, a lot of condos on the market, a lot of stuff sitting, not a lot of stuff selling. So when a new listing hit the market, I was an outlier with the listing I just sold, that it sold quite quickly. But again, I already told you, as I already said, product that was more end user is still selling. So I wouldn't be shocked when you look at these condo neighborhoods and the sales to new listings ratio at that point. If we were to take out all end user product, I bet you that sales to new listings ratio would be sub 15%. I don't know. I haven't run the numbers, but if someone out there is watching this and is good with numbers and wants to dissect that data, I would be very interested to see if we backed out all the 3 bedrooms, all the 2 bedrooms, even the 1+ dens from the equation here, what that number would be. And I would guess that that number would be below 20%, almost guaranteed. So it really is the end user product that's keeping that number in the 30s as opposed to dropping down below 20%, which would be not good news for the condo market. So thank you to the few investors out there or people who bought end user style condos. You are saving the condo market. When we look at months of inventory, which is another similar indicator of market sentiment, or if we are buyers or sellers market, generally months of inventory, when we're sitting at around 2.5 months, would be a balanced market. Anything below 2.5 months of inventory indicates a strong seller's market. Anything over about 2.5 months, we are now again in buyer's market territory. And when we look at the overall average for the City of Toronto, similar sales to new listings ratio, it's also pointing towards buyer's market because we were over 2.5. City of Toronto, we had 3.8 months of inventory. And then again, when we break down neighborhoods, months of inventory, actually it's probably a slightly better representation of where we're at right now. Sales to new listings ratio is a trending statistic. It's kind of like where we're headed. Months of inventory shows you where we're at right now. It's a bit more of like even though it says it's a trending statistic, I actually find it's a better representation of where we're at right now in the market. So months of inventory is basically a stat where it's like, if there were not to be another listing to hit the market right now, how long would it take to sell off all of the inventory? So most of the neighborhoods in the West End, very much in a buyer's market, well over 2.5 months. Means there's a lot of inventory, except for one neighborhood, WO2, which is kind of like getting a little bit of kind of like southwest end of Toronto, if you can kind of picture that. Sort of looking like Hyde Park and Bloor West and some of those neighborhoods at 2.1 months of inventory. So they're pretty much just under balance. They're actually trending a bit more towards seller's market. That pocket of the city, mostly detached houses, which we already saw. Detached houses, pricing is up, sales are up big in detached houses. People are jumping back into the detached house market. And it's generally wealthier buyers, people who have money. Look at the state of the market, look at where interest rates are, and they're jumping back into the market in a big way and buying up depressed detached houses effectively. And that's reflected here in the stats. Central neighborhoods, complete opposite. There's a lot of condos. We are sitting at high months of inventory. I mean, there is one neighborhood, C12, sitting at 7.3 months of inventory, which is ridiculous. That means it would take over 7 months to sell off all of the inventory in the neighborhood. And actually, you know what? I missed that from before. They are also the one neighborhood that's below 30% when it comes to sales to new listings ratio at 28%. Yikes. Otherwise, everything else, their numbers are high, but a lot of the central neighborhoods are again dominated by condominium inventory, which are pushing those numbers to where they're at. And then when we go to the East End, as we saw with the sales to new listings ratio, we saw what the trends were there. Months of inventory, pretty much any like downtown adjacent East End neighborhoods are, from a months of inventory perspective, actually in seller's market territory, right? So we're looking at E02, E03. There's competition there. Homes are selling. E01, that 2.0 is actually probably pushed up due to the amount of condos in E01. So E01, there's still a lot of condo inventory there. So I bet you if you remove condos from E01, they're probably firmly in a seller's market with only 2 months of inventory. And then for the rest of the East End, as has been the trend for the last few years, the East End is still, for the most part, bucking the trends. There's not as much inventory in the East End and tighter market conditions. So we look overall, the the easy thing to extract from all of this data that I see quite clearly is that neighborhoods dominated by condos have a lot of inventory. If you're looking for a house right now, the market conditions are tightening. And that's what's indicative of here. So when we look at the East End of Toronto, mostly houses. When we look at the West End, when we extract some of the condos from the condo heavy neighborhoods in the West End, even as well, we're looking at tighter market conditions. So what I would say, looking at all of this data so far, I don't know how far we're in terms of timing, but when I look at the state of the market, what I can easily say, I mean, it almost feels like a political, what I'm going to predict right now by looking at all this data is when you start to follow money. So when I tell some clients who are looking at new construction, when you look at developers who have a lot of money on the line, a lot of money to lose, but they do have a lot of money, look to where they're buying and what they're buying and what their tendencies are, what they're doing. Right. So when the developers are buying up houses in certain neighborhoods or buying development plots in certain neighborhoods, they're not buying to try and lose money. Yeah, sure. They're sometimes placing bets. And when you have a lot of money, you can be a little riskier, but they're also not looking to lose money. And same is true almost for the housing market. When you start to see wealthier individuals start to kind of trickle and then flood back into the market, right? So when we see detached house prices start to move upwards, we start to see the market conditions for detached houses start to really tighten, and there's starting to be a lot of activity and a lot of competition. That's a signal to the rest of the market where if the people who are a little bit more sophisticated and have funds are starting to come back into the market, that should be a signal that things are changing. Is it a guarantee that we're going to head back to where we were a couple years ago? Probably not. But I would start to say that if rates keep coming down, we are going to start see an eventual effect on pricing, with pricing starting to move the other way as inventory starts to dwindle. So something to be aware of. Like, by no means is that for sure going to happen, but that seems to me based on my read of this, and this is all live reaction, really haven't had a chance to digest this. That is my read, and I'll maybe make a subsequent one of my subsequent videos that I make. I mean, my next video is likely going to be talking about um what is it again? My next video is likely to be on another affordability topic, right? And we're going to be talking about the factors that are influencing some of the affordability metrics here in Toronto. Being a little vague, but watch out for that video because it's going to be a good one. Um, all right. Now, some of you watching this channel, you're here for the under the radar neighborhoods that we track on this channel. So let's now look at some of the under the radar neighborhoods and look to how they compare to the rest of the city. And when I like to look at stats for the neighborhoods that I'm watching, I like to look at the MLS home price index as opposed to the average price. I find the HPI typically has a little bit more of an accurate pricing because it removes the highs, removes the lows. It's kind of smooths out the pricing. So it gives you, in my opinion, a better read on where pricing is at. And for the under the radar neighborhoods, we're actually going to look at pricing because, again, what I keep saying and keep repeating is that these under the radar neighborhoods are trending so far below the overall average in the city of Toronto in so many different house types that it makes a ton of sense to look at these neighborhoods. So let's look at these. And for those of you who are new and might be watching this for the first time, the three under the radar neighborhoods are Eglinton West, Weston, and St. Clair West. So kind of the old city of York. When you look, if you go onto Google and you type in York, not York region, not the suburb, old city of York, pre-amalgamation. And these are the three neighborhoods that encompass that. So an area that, in my opinion, is so undervalued, but is trending in a certain direction that I think in 5 to 7 years, people are going to be kicking themselves for not getting in sooner. That's my prediction. It's not for sure going to happen, but I live in York. I moved up here from downtown because I believed in this neighborhood. So anyway, I digress. Let's look at the numbers up in this pocket. So these areas, we're to look at TREB numbers. It'd be W03, W04, and C03. All right, so when we look at the composite, so this would be all house types included. For W03, average price was $965,000. So we're to compare that to the overall average in the city of Toronto at $1,042,000, significant savings. We look at W04 at $893,700. That, W03 is kind of Eglinton West dominant. W04 is more Weston. So when we look at Weston, under $900,000 as an average versus $1,042,000 in the city. So that's looking at $150,000 difference in Weston versus downtown Toronto. And as I repeat again and again on this channel, in Weston, while it looks sometimes far on a map, you're actually quite close to the city because in the epicenter of Weston, you have an Up Express station and a GO train station. And you can get downtown on the Up Express in 20 minutes. So there's some neighborhoods downtown where you can't get downtown in 20 minutes, which is funny to say, but anyone who lives in West Queen West or lives in Riverside out of the East End, you know exactly what I'm talking about. You live downtown, but it still takes you 20 minutes to get downtown. Whereas in Weston, you can live in an area where you have a golf course. I repeat again, you have a golf course. You have a river where you can literally go fishing in the middle of the city. You have massive parks, green space. Anyone out there who hasn't visited Weston, I tell you, go up to Weston and start your journey on either Church Street or John Street in Weston. I know these are names that repeat names of streets downtown Toronto, but what you need to know is that Weston was at one point its own independent city, and it has an old Victorian downtown. So when you go into the neighborhood in Weston, you have beautiful historic Victorian homes on large lots that are quite literally half the price of similar style homes that you would find in Little Italy or the Annex or some of these other historical neighborhoods in Toronto. Quite literally half the price, right? So you could buy a large 3,000 square foot Victorian home in Weston. And if we were to look at the detached prices in Weston at around 1.2 million now, one of those big Victorian homes won't be 1.2 million, but a lot of those big Victorians are selling sub $2 million, where that same Victorian house, if you were to place it in the annex, would be well over $4 million. So if you are looking for that type of product in the city, 20 minutes of downtown, it blows my mind that people aren't rushing into Weston. And my comment earlier about following the money, the amount of money that developers have invested in Weston. I actually should do an update because I earlier in my channel, if you scroll back to some of my older videos where I was tracking what developers were buying and planning in Weston, we were looking at like 20,000 new condo units in the kind of Weston, Eglinton West pocket. I think in Weston specific, probably sitting around 10,000 to 11,000 planned units in Weston. So developers are betting big on Weston. And yet, if you follow the money, you know what's likely going to happen in Weston. So time is now because in 5 to 7 years, those big Victorian homes might actually start being priced at a much higher margin. And again, I love the old city of York because to me, it is Toronto's Brooklyn. I mean, there's some arguments online. I was in a Twitter conversation with a few people, and actually, most Torontonians actually do believe the same, that the old city of York is really Toronto's Brooklyn. And we are probably 10 to 15 years behind that same change that happened in Brooklyn. So if you saw what happened in Brooklyn, in my opinion, same thing's gonna happen here in Toronto to Weston, to Eglinton West. So time is now. So let me get back to the numbers. Yes, when we look at the percentage year-over-year change in both those neighborhoods, down over last year. Year-over-year numbers, we can toss them out the window because they don't really mean much. Month to month is where it's at, and we'll get to the month-to-month numbers in a moment. And then the other neighborhood that encompasses the under-the-radar neighborhoods, and if people already have mentioned to me, they're like, how was that an under-the-radar neighborhood? And that's C03, where the average is 1.545 million, which is like 500 grand over the overall not like it is a 500 grand over the overall average in the city of Toronto. But C03 encompasses a lot of neighborhoods that abut onto some of the priciest real estate, not only in Toronto, but in all of Canada. So, which is literally the neighbor C04. So when we look at C03 compared to C04, another $500,000 price gap between those two neighborhoods. So C03, it's under the radar because it's under the radar luxury. If you are looking for luxury real estate, C03 makes so much sense. Parts of C03 are still even classified Forest Hill. I live in where am I? W04. I'm losing my mind. But W04 even abuts a little bit onto Forest Hill. My building, while it's in Eglinton West, and I like to tell people that I live mostly in Eglinton West, Little Jamaica, my building's called Forest Hill Lofts because Forest Hill is I could see Forest Hill from my window. It's like literally a street over. And C03, that neighborhood would be in C03, right? So you're looking at South Forest Hill where you go just a little bit further north and you can pay, 500 grand more for a similar house because you're in a different zone. So C03, in my opinion, is when if we use the Brooklyn analogy, right? We are looking at neighborhoods like, let me just pull up my map of Brooklyn to give you guys an idea. So C03, if we were to look at neighborhoods in Brooklyn, just to kind of give you guys an idea, we are probably comparing C03 to areas that a lot of you probably know, like Williamsburg. My mind doesn't work this one, that's why I had to look these up. But so we're looking at Williamsburg. We're looking at Brooklyn Heights. We're looking at some of these neighborhoods now where if you look in the real estate in Williamsburg, for example, or Brooklyn Heights, or what else am I looking at here? Yeah, like downtown Brooklyn, Dumbo. Some of these pockets of Brooklyn where over the years pricing is pretty much on par with pricing in Manhattan. That's what we're talking about when we look at C03. C03, while it's expensive, we look at it compared to the pricey neighborhoods that are adjacent to it, it's a no-brainer, right? So, yes, quite expensive, but for anyone out there looking for that entry-level luxury product, this is where it is because those numbers from Forest Hill are likely going to bleed further and further into C03. Um, and if we look kind of quickly at some of the house types, I'm just going to go over them briefly, right? So W03, W04, detached houses are trending under 1.2 million, which is wild, right? I mean, the average price of a detached house in the city of Toronto is 1.6. You're saving 400 grand, but looking at detached house there. Semi-detached houses again in Weston and Eglinton West, about 200,000, right? So a semi-detached house in W03 is just over a million, and W04 is 900 grand, right? So you're saving $200,000 to $300,000. Townhouses, pretty again, big savings over the overall average of the city. W03, 800,000, W04, 727, right? So over the average in the city of Toronto is 864. And then condos, again, C03 under 600, or so sorry, W03 under 600,000, W04 under 590, right? So versus the overall average at 692 for the city of Toronto. So again, big savings right across the board in Toronto's Brooklyn. Book it now. I'm one of the few people who say it over and over again. This area is under the radar. I'm going to repeat again why it is under the radar. It has transit that is built, not planned, built. It's not, some of it's not open yet. But it's built, right? The Crosstown LRT cuts right through these under the radar neighborhoods. And it ends at the end of the under the radar neighborhoods in Weston, right? So it goes from Allen Road to Weston, cutting through all of these under the radar neighborhoods. As soon as those open, I'm telling you right now, as soon as these stations open, pricing is going to increase. I'll say it again. When these subway stations open, pricing will increase. Why? Because buyers buy when the infrastructure is ready. You'll see a bump when you see the plans go in. You'll see another bump in pricing when the construction starts. But really, things really change when it's actually open and operating. And that's where we're going to see the neighborhood really start to explode. That's when we're going to see a lot of the developers start construction on a lot of these projects. I mean, a lot of them have already started. One of my favorite projects in the whole pocket of Eglinton Weston is Beltline Yards. Watch out for that development. That's going to be kind of the epicenter of Toronto's Brooklyn. Even when you look at the renderings of Beltline Yards, go check out my video on the channel about Beltline Yards. It is a beautiful project, and things are starting to move there. So when that gets built, and that sits right next to the Caledonia subway station, I'm telling you right now, I think they're building condos there. Buying a condo there is like buying a condo in Dumbo, right? If you bought a condo in Dumbo in 1998 to 2000, you are a multimillionaire today. You bought a Dumbo loft for, I don't know, a couple $100,000 in the late 90s, early 2000s, and now that same place is worth millions upon millions of dollars. Now, this is not financial advice. I have to put that out there. There's no guaranteed returns. But again, this is my prediction, and I think that's going to happen. Anyway, let's get back to the podcast. Let's get things back on the rails a little bit. So I promised we would look at the month-to-month numbers, and that's the next thing on my list. So when we look at month-to-month numbers for this year, we have now, so October, we're at 1.135, so trending upwards from the summer. We still haven't hit the same numbers that we were hitting in the spring when rates were higher, I will add. We actually had higher rates in the spring, lower rates now, and pricing has stayed low. That's because inventory had built. over the course of the end of spring and into the summer. So inventory kept building and building and building and building. So we're at max inventory right now, which means pricing hasn't really exploded, which, and I know I've been saying this for months, but every month that it becomes a little bit more real, there's a buying opportunity. And I know I'm going to get comments. There's someone in the going to jump into the comments right now being like, oh, you're just a snake oil salesman and whatever, pumping the market and blah, blah, all these other terms that you see on realist on X or on Reddit. However, you can't argue with the numbers and you can't argue with where things are trending. As rates come down, right? And as more of this inventory gets snapped up and it is starting to process. Condo market is maybe, that's an aside. We can push that to the side for a second, but especially when we look at detached houses, semi-detached houses, townhouses, and end user condos, that inventory is getting snapped up and it's getting sold. As more and more of that inventory gets sold and conditions tighten, we're going to see things change. Even in the condo market, it's going to then trickle into the condo market, not all at once. I think the condo market, there's some structural issues there. But overall, for anything end user that people are buying to live in, those things, that market is getting tighter and tighter and tighter as rates come down and as inventory dwindles. So, with all that being said, you can say, I mean, some of the trolls can say what you want. However, there is an opportunity. Okay. So my camera was running a little hot, cut off right there. I was mid sentence, but that's about time for me to probably wrap things up. We run long. We're into the 40-minute, try to keep these podcasts under 30. So let's wrap all this up. So effectively, if you watch any of my previous podcasts, I mean, the theming of this one is still very similar. I think there's clearly some signals and signs, if even incremental signs, showing that we are heading back towards probably a balanced market and maybe perhaps into a seller's market as we head into 2025. So I'm not trying to fearmonger and tell people, hey, you got to jump back into the market right now. But if there are certain neighborhoods and certain house types that you have been keeping your eyes on, I think there is a good time to start evaluating whether it is a good time to buy, especially if you're not having to sell off another asset. If you're a first-time buyer out there, this is a pretty good window for especially first-time buyers to try and get into the market. And if you're a first-time buyer, if let's say if you don't have kids yet, or you're a single person or just a young couple, looking into some of these under the radar neighborhoods sometimes could be the way to go. I mean, I have family that, for example, live in Brooklyn. I mean, they moved to Brooklyn, they live in Brooklyn prior to it really exploding. They didn't have kids yet. They were young. They were either single or just getting married. And they've done really, really well with their real estate when they were buying in the early 2000s to kind of mid 2000s, even into the 2010s, versus where Brooklyn is today. So again, I'm going to continue to repeat this talking point, this idea that old city of York is Toronto's Brooklyn. So if you're a first-time buyer out there that's willing to look beyond the confines of downtown or some of the previously trendy neighborhoods of like Leslieville in the East End or so on and so forth, there's a shining light right here in the West End where there's an opportunity, especially as rates start to come down and prices are where they're at and quite depressed over where they were at the peaks of the market, to get into one of these neighborhoods and really take advantage of a buying opportunity that is existing in this area, in this neighborhood. So that's it for today for the podcast number 19. Our next podcast, number 20, got to 20 podcasts. These are monthly podcasts, so now it's just over 20 months of doing this, almost 2 years, which is pretty cool. That's it for today. Final thoughts, just explain them. I don't think I have anything else to add. That's it for today. Thanks for watching, and watch for some of our new videos coming out. A lot more talks about affordability and some of the factors that are really affecting affordability here in the city of Toronto. I think it's really important that we dissect some of these things. And my next video is going to dissect some of the affordability issues that are occurring here in the city of Toronto. So thanks for watching. Subscribe, like, comment, do all that good stuff. Peace out.